Hello everyone, welcome to Mr. Cobb's channel, and our today's topic is profitability ratio. Okay, so here is a brief intro about me. Quickly jumping into the topic, profitability ratio. So it can be divided into two parts. Okay, so profitability ratio basically tells us about how efficiently an organization is managing its cost and how good they are in terms of their sales. Okay, now these two are the numbers which decides where the business is going. Okay, in terms of numbers, so let's see profitability ratio. Okay, can be divided into two parts. Okay, one is margin and another is returns. Okay, so let's come to margin first. Okay, let's come to margin first. The very first margin ratio is GP margin, which is gross profit margin. Okay, the formula for this is very simple: revenue minus cost of goods sold by revenue. Okay, so this gives us a gross profit margin. So this tells how efficiently an organization or business is managing its direct costs. Okay, so if an organization is having a high GP ratio, okay, but its cost price is same to its peers. Okay, so let's have two companies where the uh, cost is say $100, and further this is say for A, for B the cost is 100. So if both companies cost are 100 but A's GP margin is a 60% and B's margin is say 50%, it means A is able to sell its product at a higher price. Now, reason being that is because the customers are ready to pay a higher price because A's product are more value adding than what B is. Okay, hence the customers are ready to give that additional price for their products. Okay, it means they have a competitive edge. Okay, maybe a one or two feature more. Okay, maybe the design is better or something is better than what is in B's product. Another way this can be high is they both are selling at same price, say 120, but A's GP gross profit margin is say 40% and B's is say 30%. Now why this is? Now in this case, if selling price is same, it means A's cost is low. A is a more cost efficient company. They are able to source their materials at a much cheaper rate, or they have technology which is or reducing the wastages, or some other way they are able to produce goods at a lower cost than what B is able to. Okay, so there's two way: either you have the ability to charge a premium or you are more cost efficient. Coming to the second margin ratio, you can guess it, it is operating profit margin. So operating profit margin. Now this is, we just keep on adding the elements. Okay, so previously we had revenue minus cost of goods sold. Now we will have cost of goods sold minus sales and marketing expenses and general admin expenses divided by my revenue. Okay, so this bit gives me gross profit and the whole bit gives me operating profit divided by revenue. Okay, so what this further tells that I'm able to manage my non-operating elements, my fixed costs better. Okay, either my fixed cost is not incremental with the increase in production, or I don't have any step up cost. Okay, so because of those reasons, my operating margins are high and I'm able to keep my costs low, non-operating costs low. Okay, so the third one is pre-tax margin. Pre-tax margin, or you can call it profit before tax margin. Okay. So the formula for this would be same. So I'll start with the revenue minus COGS minus sales and marketing minus general admin and minus interest or any inventory write-off. Okay, write-offs. Whole thing divided by revenue. Okay, so this gives me my pre-tax margin. So it is inclusive of all the other expenses, everything except tax. Except the tax bit, everything is inclusive. Okay, so this tells how overall you're able to manage your expenses, your costs, and everything. Okay, now the fourth one is most popular one is net profit margin. So net profit margin is basically your revenue minus all expenses by revenue. All expenses plus you can also tell other incomes. Okay, just rewrite this thing. Other income, other income. Okay. Now this tells us how efficiently we are like managing everything. Now, one drawback of using non-profit margin is because it includes your other incomes. Okay, and it is inclusive of all the expenses. When I say all the expenses, now in certain cases there are certain one-off incomes or one-off expenses. Okay, one-off. Okay, say you plant sold a plant at a profit, but this is a one-off. Because of this, the profit will increase, your net profit will go up, right? But when you are comparing the net profit margin with your peers or your competitors, okay, your net profit might be low than your competitors. One of the reason can be that they are having a one-off profit inclusive in their financials, okay, which will not be recurring. Okay, so due to this, net profit margin becomes little, this has a little drawback. So we can still use net profit, but it should not be used in isolation, but with other profit margin ratios or other ratios as well. Okay, so these are there. One more can be there. One more margin ratio can be there, which links the cash flow. So we can talk about operating cash flow margin. Okay, so the formula for this is your cash flow from operations divided by revenue. Okay, straightforward. Now, what is cash flow from operations? So, cash flow, oops, uh, just a minute. Cash flow from operations is equals to your net profit plus your non-cash elements. So you need to basically add back all your non-cash expenses, basically non-cash expenses. Okay, and you need to also add the changes in working capital. Okay, so changes in your working capital. So this gives your cash flow from operations, and the cash flow margin, operating cash flow margin will be cash flow from operations divided by revenue. So what this tells us is how much cash we are able to generate with every dollar of revenue. So if we are able to sell for our products of for $1, for that we are able to generate the X amount of cash. Okay, so this is what it tells how much we are cash efficient. Okay, So this is what it tells, and it is important from investors' point of view or from suppliers' point of view, because they want to deal with companies which are having good cash. Okay, we are good in terms of cash. Okay, so suppliers basically would be looking at this particular ratio. So these are the margins. Okay, the margin ratio. So next set is return ratios. Okay, so the first return ratio would be the return on assets. Return on assets. Straightforward, right? Your net profit by total assets. This tells like how much, okay, we are able to generate profit with the amount of asset we have. Now, one of the ways to increase uh, return on asset is to achieve economies of scale. Economies of scale. Okay, now what this does, economies of scale does, it reduces your cost per unit. Okay, it reduces cost per unit and increases margin, and increases margin. Okay, due to which my return, which is the net profit, goes up with the same amount of total assets. So my denominator stays same, my numerator goes up, due to which my return on asset goes up. Okay, this is return on asset. So you need to achieve economies of scale for this. Secondly is a popular one, number two, which is return on equity. So it is also straightforward. So your net profit divided by shareholders fund. Shareholders funds. Okay. Now this tells like with every dollar of shareholders fund, how much return we are able to generate as a business. Okay. So this tells the same thing. Now, one of the drawback of using this in isolation is that because the net profit can be increased with an addition of assets. So if we have more assets, more production, we're able to sell more. If we're able to sell more, our overall profit goes up, which is our gross profit goes up. Our fixed cost would remain same, due to which my net profit would go up, but that increase in asset can be funded by debt. That is not incorporated in this ratio. Means your net profit increases with an increase in assets, but that increase in asset is funded by debt. Okay, that is not incorporated. So the next ratio brings us to one which inclusive of that. So sorry, return on capital employed. Okay, also called it ROCE. Okay. Now, capital employed is inclusive of all the sorts of capital you have: your equity, your loans or bonds. Okay. Whatever it is, your loans and bonds and your equity. So it's inclusive of both. Now, this tells with a total capital of this much, we are able to generate this amount of revenue. The for profit would be the net profit. Okay, this amount of profit. So the formula would be for this one is again net profit divided by capital employed. Okay, net profit by capital employed. So yeah, now I'll introduce you to one more ratio. Now these are all ratios which are based on profits, right? If you see net profit, net profit, okay, net profit, okay. If you see operating, this is operation, this is cash flow from operations. Okay, this also starts from net profit. Okay, net profit, it's itself net profit, profit pre-tax margin. Okay, so it is net profit plus tax. So again, net profit. Okay. We see all of these ratios are based on profits. Now, what if a company who is not making a profit, okay, loss-making company, how to analyze a business which is making losses. Okay, how to analyze this kind of a company? Now, uh, the answer to this is, I'll take a different font. Price price to sales ratio. Okay, price to sales ratio. So this basically skips the profit part. Rather, what it does, it includes sales, which is total sales, and it compares it with the market price. So two way it can be calculated. One, it is at a total level, which is at market capitalization divided by total revenue, and B is market price per share by sales per share. Okay, by sales per share. So this basically tells that for every dollar of revenue, what is my market price, or how much, okay, the investors are ready to give for every dollar of sale I make. Okay, so say if my market capitalization is say dollar 10 billion, okay, whereas this is market cap, and whereas my sale is just 1 billion, okay, this is my sales. Okay, so this gives me a PS ratio of 10, right? This gives me a PS ratio of 10. So this is what it tells for every dollar of revenue. So every dollar of revenue, the public is ready to pay $10 to me. Okay. Now, why this? Because the company, the public, okay, the public or the investors in general, investors believe in the future prospects of the organization. Okay, the future prospects of the organization. They believe in the future prospect. We'll just write it here. Future prospects of the business, future prospects of the business. Okay, now this particular ratio is useful for analyzing or comparing companies which are making losses, like startups, okay, or companies operating in the technology industry, which is still growing and booming, okay, which is still young. So all those kind of industries and businesses which are young and still pre profit, okay, so the investors will be using this particular ratio. But also, but one more thing, this ratio cannot be is not very useful in isolation. Hence, it should be used in comparison with peers, because in isolation you don't know, okay, I sell $1, investors are ready to give me 10. You don't know what are investors ready to give to your competitors, okay, maybe more. So a comparison is more likely to give benefit than using in isolation. So yeah, that is it for today. So thank you for watching the video, and let me know your feedback.